The way I got to scale was partnerships. Partnership is a crucial element in this, right? I can't do it all on my own.
Hello, everyone, and welcome to the Journey to Multifamily Millions podcast. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us David McIlwaine. David is a founder and managing partner at Mac Assets, a real estate investment firm whose mission is to improve residents' and investors' lives by adding value to both. After wearing the golden handcuffs for almost 14 years, in 2019, he broke free, founding Mac Assets, and now is a general partner in over 1,000 doors. David, welcome to the show.
Thanks, Tim. It's wonderful to be here. Really excited to talk with you and your listeners and share the journey to millions.
Yeah, and we're happy to have you. So, what I did is I gave everyone a high level overview on your background, but there's a lot to tell. So, could you please get into details of how you got started on your journey and take us back to the beginning and tell us how you got to where you are today?
You bet. It's one of those journeys that, you don't see coming until it's already upon you. There's a stat somewhere that says the average career executive has 5 different careers. I think I'm on number 3 or 4. I can't quite count. I started life as in the advertising business, and I spent 20 years there on the buy side for one of the biggest ad agencies in the world in Chicago. And then I moved to Colorado and continued work on the ad agency side. Then I got into sales and I sold this really unique product. It was called traffic advertising. And I did it for about 17 years. And over the course of that time frame, I started with a phone book and ended up running a third of the US and a national digital platform with them as well. Fast forward to the end of that career, I have hit my stride running 22 states, have a staff of 35, and cover 4 time zones. The world's a little bit upside down. We're going through some turmoil, and I have hit 9 consecutive quarters of budget quota prior to the start of the quarter. Our company gets bought. We go through the great merger. And when you're going through a merger, everybody has the same 2 or 3 concerns. There's always this quote unquote accretive gain to the shareholder. And accretive gain to the shareholder means that employees are getting no ifs, ands, ors, or buts about it. Somebody's losing a job because that means they're consolidating workforces. The day the Department of Justice approved our merger, myself and everybody at my level and above was laid off that day or the next. So I'd been there for 17 years, had a tremendously strong track record, had achieved all the performance goals and quotas, and gotten bruised. I went and I licked my wounds. I got a job in the startup world for a tech company, was hired as a chief revenue officer tasked with turning over and reversing revenue declines. I did that in the course of 18 months. We stopped a lot of negative decline, got back to revenue growth. We've completed a Series B fundraising event. So we went out and recapitalized the company. I came in the day after capitalization, and the CEO said, "Hey, we paid off all our debt." And I said, "What debt?" So a week later, I was laid off. That company now, subsequently, within the year of then, was defunct. And in the course of 18 months, I had been achieving my deliverables. I'd been helping my team grow. I'd been doing all the things that we're taught to do in corporate America. And I got laid off twice through things that were not about performance. They weren't about personality. They weren't about any misbehavior. It was just situational. I had zero control over that. In the middle of all that, I went through a really rough divorce and I could no longer fly every day of the week like I had been doing and traveling all across the US and every major metro. So what did I do? I went into real estate. I became a residential agent. I got my license to flip and decided quickly that flipping wasn't cost effective for my time. The risk was greater than the reward. And if I was going to risk 50 to $200,000 in hard money out of my own pocket, and that's what I mean by hard money out of my pocket, to make 30 or $40,000, it didn't seem like a wise execution for me. So I became an agent. From there, I spent several years slinging houses, opened my own brokerage, and discovered quickly that this was something that I was good at, but didn't care for. I'm not a passionate real estate agent. I'm not a passionate realtor. I'm not going to be the guy that has my car painted with the realtor logo telling you I'm going to make your life better. It's just not who I am. One day I'm in an investment seminar and I discover that there is a speaker talking and he has up on the board a copy of his K1 for one of his LLCs. And he's got a loss of negative $400,000. Now, in my heyday selling advertising, I used to buy a missile for the Iraq and wars. And I always joked with my friends that I didn't know what my missile was named because I was paying so much in taxes. So that got my attention. I sat down and within 1 minute, I changed my entire business model. And the reason for that was simple. I realized that what I had done in the advertising world was exactly the same as what they do in the multifamily world. In the advertising world, I was selling one market, 30 markets, 50 markets, customized universes. Those customized universes were built to what the marketer's needs were, and I sold it at scale. The work was the same for one market or 67 markets. The payout had incremental zeros. Within a minute of seeing this, it all clicked, and I jumped headfirst, and I haven't looked back since. In the course of the next year, I was the general partner. I became a general partner in over 1,000 doors, led one syndication to complete execution, led another to execution, and sold it to my partners at execution, and have been operating the businesses and looking for the right buying opportunities ever since. So there's the executive summary. I don't know.
Yeah, and that's a lot. So there's a lot of points that I want to go back to on this because I think there's some interesting tidbits that led you, which, like you said, it was a wandering journey. There was definitely a lot of stops along the way. I think the first point that I want to hit is this point you raise about us being told that if we go to college, get a job, do the right thing, do what our boss tells us to do, work our way up the corporate ladder, everything will be fine. And that's clearly not the case. And you've experienced this. I've seen this in my own life with my wife, who worked for the same company for 9 years, right? And was doing everything right, got bought out by another company. And I was like, oh, you don't have anything to worry about because people, you start to see little things happening, right? Oh, there's a first round of layoff and then a second. And I was like, oh, they'll probably get rid of the most expensive people first, the people at the top who cost them the most money and where there's redundancy and stuff like that. And I was like, you're fine, kind of middle of the middle management. So you're not getting paid too much and you're not so new that you can be let go. So I didn't really expect for it to happen, but yeah, within like the third round, I guess, of trimming that they started to do, her W-2 was gone. And it was like, oh, okay, so that safety and security that we thought we had, and were we still going to be okay? Sure, because at the time we were a dual income household, right? I was still on active duty military orders, and she had her corporate job. But if that weren't the case, if we were a single income household and that single income disappears, that's devastating. So it just rings so true to me, especially that you talk about that false sense of security that we have and that assumption that if we do everything right by virtue of our efforts and performance, that we will be endlessly rewarded. And that clearly isn't always the case.
Not at all. I like to say that it's not if you're going to get laid off or fired, it's when, especially in a sales capacity. There's massive number of people out there that are top sales performers in the outside world. And they just get broomed because somebody decides that there's going to be a lagging trail and their territory will deliver results without them. In one of the mergers, our company decided that they didn't need regional management or field level management. After they laid us off, they lost a whole bunch of revenue. And eventually, over time, they recouped most of it. And I don't want to sound bitter, but I was quite happy to see them lose money because it justified that what I was doing was actually worthwhile. I saw this video in 1985 as well. When my dad was in Oklahoma in the oil booms, he lost his job twice and three times, and he was an Air National Guardsman, and he was able to go on active duty. And you realize that requirement to stay connected to the corporate American umbilical cord is what we're ingrained with. I remember when I became a commission sales guy, and my commission sales world was 100% eat what you kill. And my mom was like, "Why don't you get a job on with the railroad? Get on with the railroad and you can be there for life." Such a different thought process. If you were born in the 60s or later, you're the first generation that's going to retire without any kind of pension. Or the second, my kids will never have a pension. I will never have a pension. It's incumbent upon me to be the owner and founder of McIlwaine Investments for the McIlwaine household. And I learned that a long time. And the thing that's powerful about this is when I was making money in corporate America, I made several mistakes. One of them I want to talk to your listeners about was that I at one time owned 4 houses. Now, why would I need 4 houses? This was before Airbnb, and I had a beach house, I had a lake house, I had a beach and lake house is one. I had a mountain house, I had a primary residence, and I was building a new primary residence. That money didn't materialize into my pocketbook. And over time, I ended up selling all of those. And after the divorce, they were all gone. And I had very little to gain for that. So I bought consumables. I traded up lifestyle. However, I also did some things that were really solid during that time. When each kid was born, I invested in a 529 for them. Now they're going to college and both 529s are paying the entire freight and it doesn't cost me a penny out of my day-to-day income. And that's the gift of those golden handcuffs is that I used them to create freedom. I also built a portfolio. I invested in all kinds of different real estate as well. And I learned how to get money outside of my W-2. When the W-2s disappeared, and they inevitably will at some point, I wasn't stuck panicking. I knew that I had a backstop. I knew that I had resource. And I knew that I had skills that would allow me to continue to go forward. And I think all of us have that. Just like your wife, I'm sure had to go through the same thing with her layoff. I watched my dad go through it. I watched neighbors go through it. I can't tell you the number of friends that come to me after I talk about this kind of thing, and they say, "I've been there. What do I do?" And it's
Yeah.
compelling.
Yeah. And you're absolutely right. I think going a little bit on the mindset thing, it's how you react when those layoffs happen and what you choose to do moving forward. Me and my wife had to talk about it and said, "Hey, you were thinking about going to grad school. If you're going to do it, now's probably the best time to do it. I'll hold things down. You go to grad school full time, just knock it out." And that's exactly what she did. She went, got her MBA in 18 months and got an even better job, obviously, on the other side. So no complaints there. You
Kudos
talked
to
about,
her.
yeah, no. And now actually she's becoming more like what the typical millennial workforce today, which is not staying at a job for more than 2 years. And that's basically what she's done. Job top, getting a promotion every time she does. So it's strange that because we no longer have that pension system around, the loyalty to companies is no longer there in the way that it used to be.
Absolutely. It's never been there from the company to the employee, and now the employee has finally realized they too have power. And you've seen that a lot in the economic cycles in the last 36 months with COVID and the response of the great, quick, early retirement from people that said it's just not worth it. And you see it also from the millennials have a phrase about, I don't know what is it passive quitting or when they
Quiet.
basically own it, quiet quitting. Yeah. When they phone in their job and do the bare minimum. And so we see this in a bunch of different ways, and our society is changing and evolving. And it's up to us to be in charge of our own financial destiny. And that's what makes me so passionate about multifamily and commercial real estate in general.
Yeah, and you talked about how you started to, I guess, basically diversify into these other assets so that you have additional streams of income, moving from that consumable to an asset mindset. How did you get started into passive investing in multifamily? And did you do that before you got onto the active general partner side?
Yeah, great series of questions. So I got invested early on in some commercial strip malls. My father-in-law was an architect. And prior to the Jobs Act of 2012, syndication really wasn't an industry. We had the ability to raise funds privately, but never through a 506C. And so if you didn't know somebody, you couldn't get into a commercial real estate syndicate because they were very much the country club world of the white shoe lawyers and well-heeled one percenters. So I actually was able to get into that world a little bit. I did some strip mall development with some other partners as a passive investor. Those returned okay, weren't great, but they were good. And one of the most important things about it was that they didn't reprice every day. I didn't see the volatility of the stock market. And I enjoyed that. And then I went looking for more and I ran into the headache that I will never forget. If you have a net worth of 1 million to 10 million, the brokers don't care about you. Let me say that again. If you have a net worth of 1 to 10 million, the brokers don't really care about you because you're not going to give them enough money to make it worth their time to give you the beautiful things. My broker said to me, and I'll never forget this, Hey, you're in Tinaville. At the time, I was asking about IPOs. IPOs were hot and fresh, and everyone is fighting to get IPO shares. He said, "You're Tina." I'm like, "What in the world is Tina?" And he said, "There is no alternative. You need to buy stocks, tracking stocks, and put everything into the diversified portfolio that Wall Street calls diversified." So what's diversified mean? You got bonds, you got some high flying tech stocks, you got some large cap, small cap, mid cap. Let's go international, and they're going to balance this whole thing to quote unquote diversify it. But the reality is you're buying the same thing. You're buying financial instruments from one company that is publicly traded. And let's say you buy the Russell 2000 index. Okay, you're buying the top 2000 small companies. When I was working for this division that became ultimately a division of Viacom and CBS, we were on the Russell 2000 and we had $500 million in revenue. That's a small company. So what I realized was that from a diversity point of view, there is no alternative means that you're going to buy publicly traded stocks that are driven by the needs and requirements of Wall Street. You then see in 2008, Merrill Lynch got this huge class action filed against it for pumping and dumping stocks. I was in that pump and dump. I lost money in it. The SEC, the New York Attorney General at the time, got $165 million settlement. Not a penny of it went to the shareholder. It went to the New York AG's office. So my money was gone. And I started looking for other things. So that was part of it. So that was a passive segment. I wanted to buy into hedge funds and couldn't because I didn't have enough money. I
Mhm.
wanted to buy into private stock offerings and couldn't. I couldn't find the connections and the resources. So the Jobs Act of 2012 really changed the structure. And if someone tells you there is no alternative, contact me. Let's talk about it and we'll solve that problem. Or contact you, Tim. All of us have the same thing, right? There is an alternative. You don't have to be committed to just the vagaries of the stock market. And so I started passively. I got into it passively and I realized as a full-time real estate professional already, and as a previous leader and as a broker and as an analyst in my previous worlds, that I had the skill set to make this my full career. And that's what I did. So as soon as I realized I was going to make this my full career, I quit passively investing in other people's deal with my taxable dollars. I still passively invest through my retirement instruments, and we can go down a whole conversation around that. But that's my journey. I realized real quickly that I was going to invest alongside my people that I was going to bring in, my investors. And there's only a finite amount of money. And if every deal costs you 50 to 100 to $250,000 to invest in, you run out of investment capital fairly quickly until you're a $10 million guy. And then it's a different game.
Yeah, absolutely. And I think that last point is important because we always talk about having skin in the game, right? And I had this, I guess, mindset too when I first started as a passive investor. Hey, this guy better have as much money into this deal as I do. Otherwise, he's not committed. He won't feel like he has skin in the game. But once you switch over to the other side and you become active, you're like, oh, wait, that doesn't really make sense because you will be out of capital very quickly if you put in a large percentage of your net worth into every deal that you are a sponsor on. It just comes down to you won't be able to do as many deals. If I'm putting $100,000 of my own capital, guess what? I'll be able to do one deal until I get to that point to where I have an enormous amount of capital to deploy. And then, yeah, I'm certainly going to increase the amount I put into it. But I think besides the money, and don't get me wrong, I think that sponsors should put in their own capital on every deal.
Absolutely.
It's just a matter of degree. But outside of that, the most important thing that they have to lose is their reputation. And so I think once people understand that as well, they'll understand that skin in the game is more than just the money that should be there, but that reputation is probably far more important to that syndicator than if they lose $50,000.
Yeah, I couldn't agree more. Let's go into that ethics conversation for a second, right? About reputation and skin in the game. When I syndicate something, my compensation in the capital stack is at the absolute bottom. The way the money gets paid out, so everybody knows this. Let's talk about this in honest, open terms. I'm doing this to do several things. One of them is to help people. One of them is to help my investors grow their net worth. One of them is to actually create something that is valuable to the consumer and improving apartment complexes or strip malls or self-storage facilities. And then one of them, let's be really direct, is for me to make some money. I get paid to do this. Now, how do I get paid? I get paid basically an acquisition fee or commission when we close a deal, just like every other broker does in a transaction. But why would you get paid to close a deal? Let's say I'm going through a process. I've got 3 different contracts out. We're waiting to see what's going to happen. I'm spending time, energy, resource, legal, due diligence funds to execute on these contracts. I've got to recoup those expenses. Then the order of payment from there is really complex. It becomes the bank because they are the largest shareholder and you got to pay the mortgage. Then you've got to pay the operating expenses of the company. Then you've got to pay your investors any preferred return that was guaranteed, promised. I can't use the word guarantee because nothing in life is a guarantee. That was part of the pro forma commitment. After that is turned over, then depending on the way the deal is structured, I may or may not share in cash flow until there's a capital event. And at that point, the capital event, let's say the capital event occurs, that could be 3 to 5 years from now. I might not get paid on a deal for 3 to 5 years. And the premise is I'm going to walk away from it. No way. I got 3 to 5 years of work in there. I've got 3 to 5 years of ego, of sweat, of reputation, of promise, of lost sleep, of trips and drive-bys and phone calls. You don't walk away from this if you're an ethical person. And the pay is at the end. The pay is not in the beginning. And the pay is aligned. So when I put money in, I get paid as a passive investor and I get paid as a general partner. Okay, great. And I do put money in my deals. So I do that for many reasons. One is the bank wants all the general partnership to have equity in the thing as well. There's situational, or there's a philosophical construct that says we all must have our own money invested. And that's true. But if you're a key sales guy, you have your ego and your reputation invested in the brand that you sell for. If you're a key operations executive and you're running a project, you want to make sure that project is high and tight. I know you used to be in the Army, you're still in the reserves. You're going to have pride in your battalion. That pride is crucial to this. That ownership is crucial to all of this. And I think that's a core part of who we are as entrepreneurs, is to make sure that we take ownership and take possession. I see more of that than I see anything else.
Yeah, no, absolutely agree. That extreme ownership and integrity, which goes back to the reputation. But from a practical perspective, if you're a passive investor and you're looking at this and wondering how we get paid, it's true what you said. You have the acquisition fee at the front end, but that's 1%. The bulk of how we get paid is on completion, successful completion, which is
Profitable.
right, profitable, which is 3 to 5 to, in some cases, even 7 years down the road. So if that isn't incentive enough, you can also look at other things in terms of, like you said, alignment of interest. Does it have a preferred return, which goes to you first? What are the splits on the deal? 70-30 versus 60-40. And depending on the class of share, I've seen it even go 50-50 over a certain threshold, et cetera. So those are the kind of things when you're really digging into the returns that you can see whether there's alignment of interest with you as the passive investor, I think.
Absolutely. Couldn't agree with you more. Alignment of interest is crucial. I think we beat this horse, haven't we, Tim?
Yeah, absolutely. All right. So I want to go into, you talked about doing 1,000 doors, and I looked at when you got started, 2019. That is a relatively short period of time to have done that many deals or that large of a deal. Who knows? It could have been one deal, but I'm assuming it wasn't. So if that's the case, how were you able to scale?
Scale, that's one of my acronyms that I use as to why I go into multifamily. And so the way I got to scale was partnerships. Partnership is a crucial element in this, right? I can't do it all on my own. There's an adage that real estate is a team sport. And in a lot of ways, commercial real estate is very much a team sport. It's extremely difficult to do all of this on your own. I just added a full-time a partner that's a head of acquisitions that I'm really excited about. And so last year I was 100% on my own, and I didn't get a deal done. I terminated 3 and couldn't get over the finish line because there were things that kept happening. And the first couple of years, I had partners that we were working with. And obviously last year was a falling knife economically, so I wasn't too stressed over not getting a deal done. I didn't see the right trigger to pull, and that's why I termed 3 deals during due diligence. So the answer is partners and then work ethic. And I'm one of those guys that once I see something and I know it, nothing gets in my way. And if I can see the opportunity, I know it's a solid opportunity. I view challenges in a real estate transaction as to-dos, not as barriers that you get stopped with. For example, let's say there's a problem with financing and the lender says to you, I'm going to pull out. Okay, do you have 2 and 3 backup lenders? Have you gone through the process in parallel? Consistency is crucial to this stuff. And the way I was able to get to scale was to really do that and to bring in partners to let them handle the things that they were experts at, and for me to handle the things that I was expert at.
Yeah, and you talked about hiring, what head of acquisition?
Yeah, he's a
Was
partner.
that
He's not a hire. Yeah.
okay? Yeah,
Yeah.
that was going to be my next question because I'm always interested how people go from the more solopreneur level of their multifamily business to some of these folks who scale to organizations, multiple employees, and I always wonder what that inflection point is, right? When you decide to make that first full-time hire, and then that second one, and that third one, and what should those positions be? So, I don't know if you're there yet or if you have any thoughts on that, but certainly
Been
interested
there,
in
done
your
that, had the merit badge, changed it around. So I went through 4 VAs last and couldn't find the right connection. And there's a little bit of spirituality, I think, in business that we ignore. And I believe very much in, okay, I need something. I ask my higher power to connect with me about it. We process through it. And then I just open myself up. The way my acquisitions partner came with me to me is that I was helping him through a career change. And we had a mentoring conversation. And he had a job offer, and I laid out for him, we laid out the pros and cons of each job. And at the end of that series, I said, hey, let's do one other. I said, what's the pro and con of coming to work with me and doing X? And I didn't know the answers because I didn't know what his answers were going to be. And that's how that came to be. It was really powerful. From a scaling point of view, the prevailing thought in the marketplace right now is hire before you need them. That's great if you have the cash flow for it.
Sure.
And if you don't have the cash flow for it and you're going to bootstrap it, just like every tech startup, you bootstrap it until you figure out what the biggest hole in the dike is you got to fill. And then you fill that with the hires. And the definitions of that hole in the dike probably are non-revenue producing activities that don't drive your business forward that you can offshore. And I don't literally mean offshore, but maybe you can offload them to a third party. I have a marketing agency I work with. I have another consulting firm. I have a due diligence firm I work with. I have a legal firm I work with. So I don't have to have all that in-house.
Yeah, and I think that's the interesting thing, like, once you actually do the analysis to say, "Hey, what is work that is vital for me to be doing? And what are the things that I can offload to someone else?" You start to find more and more things. You make that first hire, for me, it was a VA, and you're like, "Okay, I really need him or her to take this off my plate because while I'm okay at it, it's not the best use of my time." And then you're like, "Oh, there's that other thing that I do too that wastes a lot of time when I could be used courting investors or whatever." And you start to find more and more items. And then you're like, wow, I could scale a lot quicker if I was working with a marketing agency, this stuff. And it just starts to compound. But yeah, I think you need to get to each level and move on from there. And before you know it, you've scaled your business and you're much more efficient. I think that's the biggest game that comes even with your first hire, whether it's a part-time VA or a full-time VA, is you become much more efficient with your time and start spending it where you should be instead of on the things that don't matter as
And it's just the same in corporate America. So
much.
when I was in the sales world in corporate America, they wouldn't hire assistants for us. And so one of the big things that really good reps did is they would go out and hire an assistant out of their own pocket because it would free them up to sell more. And you get to a point in your career where you have to determine what's important to you. I remember I taught my son and my daughter the same lesson, which was that at one point I was so busy at work, and I know there are a ton of investors out there like this, that you're working 60, 70 hours a week. You come home and you look at your yard and you're like, damn it, I got to mow the yard this. And then you're like, no, I don't want to mow the yard. I want to go play with my kid. I want to go to his baseball game or his wrestling match or her cheerleading game or her wrestling match or whatever it may be. And I want to be with my family. So I hired a lawnmower, right? And I was making 3 to $500 an hour. And the lawn for me to mow my lawn was costing me $450 in time. And my son's like, "Dad, why aren't you mowing the lawn? Because we're rich?" I'm like, "No, we're not rich. I'm choosing how to allocate my time, and to pay this guy $50 to mow my yard means I can spend this time playing with you and building Legos. And that's more important to me." Or to my daughter, the discussion was around helping her with her Girl Scout stuff. And it's the same thing in work. If I'm spending my energy on non-revenue producing activities, I'm working in my business, that's great. But if I only work in my business, I can never work on my business. And working on my business propels my business to my big, hairy, audacious goals.
Yep, and you're
So
right, and that's why I think people, like, just every once in a while need to step outside themselves and evaluate and say, like you said, "Am I working in my business more than I should be?" Because otherwise, you'll never be able to pull yourself out of it, and you could stay in that cycle forever because
that is the
people,
golden handcuffs.
right, people do it.
And there's
Uh,
nothing wrong with that if that's what you want. But
right.
if you want some more control over your career and your net worth, making those decisions is great. Hiring a housekeeper was a time buyback for me. I got back 3 hours a week. Okay, no problem.
Yep, absolutely, I'm right there with you. I know you advocate for something that some in the industry may not support, which is staying in the stock market, but having multifamily as one of your alternative investments. So I'm just curious why you think it's still worth keeping stocks in your investment portfolio? Because I know once we get into our multifamily bubble, I know so many people who are like, nope, 100% real estate, 100% multifamily. Like they will not deviate, and maybe that works for them. So I'm just curious to hear dissenting voices on that.
Thank you so much. My email is david@macassets.com when you want to throw hate mail at me. Okay, here goes. You're stupid if you just go to just multifamily by itself. In everything, there is moderation. You don't go buy just one type of meat your whole life and think that's all there is in meat. When you invest, you want to invest for yield, alpha, return, however you want to pick the nomenclature of the day. You're putting a bet every single time you're making a bet. So if you're playing, because if you're in the casino and you're playing, you take good house odds where you can, right? Now, I'm not a gambler, so this analogy is a little bit off the hip. What's the best game for the odds of the casino to win? I don't know. But is that the game you want to put all your money into? No. Do you want to put a little bit there because maybe you think that you know something they don't know? It's the same with real estate. It's the same with crypto. Man, I'm glad I didn't have all of it in crypto last year. God, I'm glad I didn't have all of it with Madoff. I'm really glad I didn't have all of it with Ponzi. I'm really glad I didn't have all of it with General Motors in 2007 when they went bankrupt in 2008. My point is that you diversify operators, you diversify geography, you diversify asset classes, you diversify stocks that you buy, you diversify target types. If you do everything trying to hit a home run and you bat 300, you're a Hall of Famer and you're still going to strike out 700 times. So to go all in means that you 100% have no other things that you think are going to grow in the market. And I think that's a fool's errand. The reality is that if I'm a corporate employee, I have a 401k. So long as I'm working in that company, I can't move that 401k money into the stock market. I can put an IRA funds in there, but you know what? Let's say I'm a regular, good old fashioned guy and I have an IRA that has a $10,000 balance. I can't invest that passively into real estate because it's not large enough. So what do I do with that? I put it in the stocks. Why? Because it's the best thing for me to do at that moment. And the way we invest as individuals is what's best for us at that moment. And what's best for me may or may not be best for you. But I'll tell you this, we can have a conversation around it and I will listen to what's going on and I will help you figure out what is best for you. I'm not going to tell you what's best for you. That's your job. My job is not to tell you anything. My job is to help my clients build their net worth by giving them the information they need to make the best decision for them and their families. Period.
Yeah.
I've never seen a guy that said, I've got to put all my stocks into just one stock.
So your point is like obvious, right? It's diversification because it reduces risk. And so I think,
Multiple bets.
right. Yeah. And I don't disagree. I think, and there's multiple ways that you could do that, right? Like even within my own household, I'm the real estate guy. My wife is more the traditional 401k. And so we create that diversification within our household through that. She is a saver. She saves a lot of money. I invest whenever I get. She has her 401k through her corporate job. And what is that invested? Obviously, it's in stocks because that's pretty much the only option they give them. And whereas I'm invested heavily in real estate, but then we also have our 529s, which you mentioned earlier, and that's something we got started for our daughters. I think when they were 0 and 3 years old. And what is that invested in? Stocks. Why? Because it's a good long-term play. It's one of those things, the earlier you get started, the better. The magic of compound interest. If I'm starting when they're 1 or 0 years old, 18 years on, it's probably going to look pretty good despite the volatility of the markets. And so I think your point holds that it's really dependent on your situation, your circumstances, risk tolerance, all of those things, because that's what it takes to create an investment strategy, right? There is
Yeah.
no investment strategy that says, do this one thing and do this one thing only.
And if you look at someone like Jeremy Roll, he's a little bit of a deity in the syndication world because he's done so. He talks about diversification. He's doing real estate that's passive investment. He's doing active investment in self-storage. He's doing ground up development. He traded stocks for a long time. He's at a place where he knows what his needs are. And that's crucial to all of this is that we get to where we know what our needs are. Look at Mitt Romney for a second. When he ran for president, and I think it was 2012, I don't quite remember. I think that was right. He had $150 million or more in his IRA. I got to look this up. It was a self-directed IRA. He worked for Bain Capital, hedge fund. How did he get $150 million in his IRA? My dad asked me one day. And I said, oh, he's Mitt Romney. He owns Bain. He's a big dog at Bain Capital. He's loaded. I don't know. I can only put in $2,000 a year into my IRA. And at the time, that was a maximum contribution level. And I couldn't buy a Roth because I made too much money. And Roth still capped some of that stuff. So you still have these rules as highly compensated employees you have to play with. So if you're a highly compensated employee, like Mitt was, you create deferred compensation. So maybe the thing to do is to do LP rolls in your SDI, in your self-directed IRA or self-directed solo 401k. You've got to be creative. So Mitt was creative. He knew, and this is where I'm going with this. He knew that as a business owner, he had choice to work within the tax code to maximize his system. And that's what all of us have to do. So one of the reasons real estate's so powerful is you can work within the tax code. One of the challenges is that tax code is limiting. So if you need tax deferred income, this might be the way to do it. If you need to hedge your bets differently, it might be something different. Is life insurance an investment? I don't know.
It depends. Yeah.
Depends on how you view it. So if you're not buying life insurance, does that mean that you're all in on multifamily? I don't know. It depends on the situation, right? That's my point. And people talk about this as it's the next best thing since sliced bread and water. It's really good, but there are problems with it. Like everything, nothing in life is guaranteed and nothing is perfect.
Yep.
Now my rant's over.
No, it was a good one. And hopefully it starts a lot of conversation.
Yeah. Hit me up, yell at me, tell me I'm wrong.
All right. But with that, we do need to move on to the turbo round. So I'm going to ask you 3 questions that I ask every guest I have on the show. And I just ask that you answer them and pretty quickly.
Great.
First one, what is one red flag every investor should look out for?
Deferred maintenance.
All right. Go into that a
Self-explanatory.
little bit more.
Oh, okay. Okay. I mean, I thought you wanted to go fast. So deferred maintenance, because the reality is that deferred maintenance tells you several things about the previous owner, and it may show you where the problems are hidden, and it may show you how the operator is going to investigate and correct and address and grow the scale. If they don't talk about deferred maintenance and they say there is none, boy, I'm running to the hill.
Yeah, absolutely. Especially one of the first things I always look for is roofs, right? Like, when was the last time the roof was replaced? All right. Do you have that in the budget to get replaced if it's been 6 years, 8 years, whatever the case may be? Just because it's one of the largest expenses, then you can go into HVAC and all that other stuff. But yeah, definitely.
Yeah, and I actually have, one of the things I look for, the roofs are given to me. I look for trees that are where the plumber will have laid the main lines to the street.
Yep. And then getting
Where those
out
roofs-
there. Yep. Because a lot of times once they start scoping those pipes and they see a giant root coming through them, can be a terribly expensive fix.
Oh yeah, it can be more expensive than a roof.
Yeah, absolutely. All right. Question number 2. What is a myth about this business that you would like to set straight?
It's great for everybody.
Which goes back to our previous discussion on investing strategy.
Right. It's not great if you want to have control over everything in your world and you think that you know the right answers for everybody else. Not great unless you can let go of some of the control and put trust into a team. If you're a passive investor and you have to control it, go play small ball and flip it.
Yep, absolutely. All right, last question. What does success look like to you?
For me, success professionally is going to be making this business large enough to be self-sustaining so that my children have the choice to be in it or not in it. And I have to have the problem of a transition plan in 10 years.
Yeah, that's a great problem to have. I hope to have the same problem one day.
Yeah.
All right.
That's the great success metric for me.
Yeah, and I hadn't really thought about it that way, but that's absolutely true. It's that legacy, right? Creating that legacy for your children.
For me,
Generational
it's not legacy and generational wealth for me per se. It's building something valuable. I was in the ad business for 20 years. What did I build? I got a lot of ads for Boston Market or Allstate or State Farm, or I did some work with United Airlines. It was really cool stuff. I did some work with Pepsi and 7-Up and Coke, and I can name a whole bunch of really cool brands, but what did I build?
Yeah.
This builds something.
Yeah, and I think for me, part of the motivation too is to show my daughters what's in the realm of the possible. Show them that they don't have to follow those guidelines that we talked about at the beginning, which is you have to go to college, then immediately get a corporate job and do that. That entrepreneurism is something that you can do if you choose to. If that's where your passions lie, and there are ways to find success in that. Because what I found is if you're not exposed to that when you're younger, you don't think about it as a possibility. So I'm not saying they have to choose that path. I'm not saying they have to be real estate investors or anything but if it broadens the idea in their own mind of what is possible for them, then I think that's
Totally. Goes back to the whole thing about my mom saying, get a job on the railroad and stay on.
Yep. All right, David. Hey, this has been an amazing conversation. Please tell our guests how they can get a hold of you and if you have anything else that you'd like to share with them.
Thank you so much, Tim. It's been a pleasure talking with you and ranting a little bit. My email's David at Mac Assets. The website's macassets.com. I do have a due diligence checklist on how Mac Assets does things as a educational piece if you want it. I also wrote a book on how ugly apartments deliver beautiful returns if you want to dig into what I said about the analogy of scale. Feel free to reach out anytime.
All right. We'll certainly have all that information in the show notes. Again, appreciate you coming on, and I look forward to seeing you continue to do big things on your journey to multifamily millions.